Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
So this week we're looking at international governance issues. So this is related to next week's material as well. So next week we'll be looking at the governance structure specifically in different countries. So you'll find that this week's material is actually not in the textbook. So a lot of the points that I cover here are not from the textbook. And there is one article that I'll refer to that you see that I borrow quite a lot of the material from that article. So I'll refer to that in a while. Let me just turn this down a bit. This thing is so difficult to read. Okay, so in terms of the topic itself, this week's topic is actually not that tough, okay? It's trying to get an understanding in terms of why there are international governance issues. So what I'll introduce to you is these two concepts, main concepts, multinationals, also sometimes known as MNCs, okay, multinational corporations. So MNCs, and then we'll talk also about cross-listings. Right. So firstly, in each of these two things, we need to understand, firstly, what is the multinational corporation, so what it is. Okay, so the definition, how would you describe it, what are the characteristics, and then we want to know why such structure exists, why do we have multinational corporations, and what issues exist in terms of multinational corporations. So because this is a corporate governance course, we of course want to think about the issues in terms of corporate governance. Right? What are the issues involved in terms of corporate governance issues in terms of international or multinational corporation? Similarly, for cross-listing, we need to know what is cross-listing, okay? How do we define cross-listing? And how could you achieve cross-listing? So we will do that through looking at the mechanism for cross-listings. And we need to understand the reasons for doing a cross-listing. So this is similar to thinking about multinational structures. Why does that structure exist? So we need to think, okay, why would a company want to cross-list, right? What are the benefits? And then we also need to think about what the costs are for cross-listing, right? So again, here in terms of the costs and benefits, we need to relate it to what issue? Corporate governance, very good, right? So because this is a corporate governance course, so always thinking about what is the corporate governance issue in terms of multinationals and cross-listings, right? So then next part, in the second half of the lecture, we're going to talk about the internationalization of capital markets. Big word, internationalization. All it means is that why do we observe multinationals and cross-listings in the capital markets, and has that changed over time, right? Has that increased, has that decreased? And we want to look at some of the trends and observations in terms of these capital markets. And specifically, we're going to look at the bigger countries such as UK, the US, right? We're going to look at, well, what is the structure involved in terms of the capital markets? What is the ownership structure? Meaning, do they have more dispersed shareholders, or is it more concentrated within some shareholders, right? Do we have more listed companies, or do we have less? Has it changed across time? And then we make some observations in terms of why do you think the structure exists in this particular country in this way? because this is then going to help us in understanding or looking at the corporate governance framework in the countries next week, right? Because now we observe the trends, then we will start thinking about, oh, why is Germany so different from the US? Why is it so different from the UK? Is it because their rule is different, their regulation is different? And then we'll study that next week, all right? And then we're going to think about, again, challenges with internationalization. That's really bringing together, looking at multinational and cross-listing in terms of the corporate governance issues, right? So what are the challenges? So in terms of today's workshop, I mentioned this thing about jurisdiction conflict, right? Remember this? I mentioned this in the very last question, jurisdiction conflict. So here, when we think about the internationalization of capital markets, you then can think about the jurisdiction conflict as well. And we'll give you an example in terms of where the conflict comes from. And then next week in the workshop, you will look at specifically that example, okay? So that's in next week's workshop question. Okay, so what is a multinational corporation? Right, so here, I said corporations are created within a specific jurisdiction but operates in home country as well as in other multiple countries around the world. Okay, so it's set up within one country, but it operates in many other countries. So companies that you're familiar with here, right? BP, you can see BP everywhere. BP gas station is in Canberra, you can see them. You can see them, I'm sure, back home in China. You can see them in Singapore, in the US, everywhere. Coca-Cola, all right, it's also a multinational. That brand name you're very familiar with. Volkswagen, the car company, again, they produce cars, but you can see that brand name everywhere, right? You recognize it. Nestle, a food production company, again, you can see that brand name. And of course, Sony, everyone knows Sony, right? So these companies all operate, was created in their home country, but they're operating in other parts of the world, other countries. And some of these corporations as well are listed in more than one stock exchange. So they're not only listed on the stock exchange back home where they're set up, but they can be also listed in other stock exchanges as well. For example, BP is listed in London. BP is also listed in Germany, all right. Sony listed in Japan, but also listed in the US, okay. So they can have dual listings, so multinational companies can also be cross-listed, which is the next thing that we'll talk about later. All right. So for a very long time, a lot of these multinational companies come from Western Europe, they come from places like the US and also from Japan. But we know that in the last, probably since the 80s, since the 70s, we see that a lot of the multinationals appearing from China, for example, also from South Korea. So these are the names that we should be familiar with, right? Huawei we should be familiar with. Lenovo, because some of you might be also using the computers, right? And then Samsung, a Korean company. So these are multinational companies that we are aware of, and they're fairly new compared to some of these older names, like Sony and Coca-Cola and Nestle. They've been around for a long time. But these may be relatively newer, okay, but they are also very established, right? Okay, so we want to start thinking about what are the characteristics of multinational corporations, right? So what will be the characteristics that you think of these companies? Okay, time to have some Kit Kat, right? Right, someone wants to start us rolling. There's quite a few things you can say about these multinationals, right? So what do we have? What do you think? Yep. Multicultural management and employees, very good. Okay, so excellent. So that's one thing. So because they're spread around the world, they're likely to have multinational employees, management. Okay, what else?
Large scale.
Yep, large scale, very good. They're very large scale. Okay, well, I think I'm going to give away a lot of these. That's good. Right, large scales. Anything else? Come on, surely we can think of some. What do you think about their products? High demand, very good, right? It should be high demand, or else they won't be existing, right? So they should have high demand. What else can we think of? High quality, okay, very good. High quality. Anything else in terms of products, right? Anything else we can think of?
Customize for different regions.
Sorry?
Customize for different regions.
Yes, I didn't really have that down, but that's possibly customized for the region. There you go. Good catch. Anything else you can think of? Very good. Advanced technology. They typically have advanced technology, right, with these multinationals. Okay, anything else we can think of? We're hitting the right points, right? Okay, so let me show you my summary. So I think of them as having very high assets turnover, so that's the large issue, right? So they're large size. We hit on the technology part, sophisticated technology. We hit on the good quality products, right? So we've got that. We've got, they must be of demand, okay? So that could possibly come with the marketing and advertising that they do. Continued growth, right? And we hit on that. And then we talk about the multinational in terms of the employees. They must have to have the right skill sets to actually do this. So there's a lot more that we can say, but this is what we tend to think of as multinational, right? They're large. They must be profitable because they have good products. The products are in demand, so they must have good marketing and advertising. So actually one of those that we didn't list down as a multinational corporation is Apple. Right? Apple is a multinational corporation. It operates all around the world. It's very, very forceful marketing and advertising. Okay, so these are some of the characteristics of multinational corporations. So this gives us some idea in terms of what we're thinking of, right, when we think multinational. But the key point that we want to remember with a multinational is that it is operated, right, in many different countries, multiple countries. It's not that they just sell the products in multi-countries, right? Remember this. It's not that they're selling in multiple countries. It's that they're actually operating out of those countries. So they might be manufacturing. So for example, Apple, they might be manufacturing in China. Ownership is in the US, right? But they also have operations in terms of the sales offices, in terms of their administration in different parts of the world, okay? All right, so that's the characteristics of a multinational corporation, and they hire also employees all around the world, okay? So this has essentially governance issues, right? Because if they operate in different parts of the world, then we've got to think, okay, what are the governance issues involved, right? What are their responsibilities involved? Okay. So before we go on to that in terms of thinking about the governance issue, let's think about why would a corporation operate in multiple countries? Why would they want to do that? Why would someone like, for example, BMW that produces cars, produce a car? It's a German company, but where do they produce their cars? What do you think? Do they manufacture in China? Yeah, they manufacture in China. Where else do they manufacture? Shanghai, okay, that's still China, right? Where else? India. Where else? Okay, I wasn't aware of Indonesia. Probably. Oh, you're not sure. Okay. I know they produce in South America as well. So they produce in different parts of the world. They produce also not in just Germany, but they also produce in Belgium, which is sort of still in Europe, but not in the same country, right? So the question is, why would they produce in different parts of the world? So here, we have access to lower production costs, right? So access to lower production costs, so when, for example, BMW or even Honda decides to produce their cars in Thailand, all right? So Honda is a Japanese company, but they produce their cars in Thailand because what do you think the labor cost is compared to in Thailand compared to Japan? Cheaper, lower, right? So it will be a lower labor, right? So exploiting the cheaper labor. You also need to think about the raw materials. So if the materials is actually being produced, the raw materials is being produced in Thailand itself, it might be better actually to produce the car in Thailand rather than have the raw material shipped to Japan to produce the car and then ship the cars back to Thailand where they want to sell in the local market. Right? So here is in terms of lower production costs, in terms of raw materials and exploiting cheap labor. Right? So that's access to the lower production costs. So that's that's the first point. The second point is proximity to the target international markets, right? So when you actually operate in that particular country, you have direct access to the local market. So if you're producing cars in Thailand, you would be able to sell the car more easily, right, to the Thai people because you are there. So that's access to the local market. It's also easier. So here, when you sell to the local market, it's also reducing your transportation costs, right? Because you don't have to then incur the cost of shipping the raw materials out, again with the car scenario, shipping the raw materials out to Japan and then producing the cars and then shipping the cars back again, all right? Same with Toyota used to produce cars in Australia, right? That again helps to lower down the transport costs. They don't have to produce the car in Japan and then from Japan ship the cars here. They just have the raw materials here, get the people to build the cars to the Toyota standards and then to sell to the local markets. Okay, there's also easier access to consumer feedback and information if you actually operate within the country, right? So that's tapping the ability to actually get those feedback more easily, okay? So that's proximity to the target international markets. And the last one, and perhaps one of the really big things that has arisen is the avoidance of tariffs, right? So if you think about, I was going to use the Trump situation, right? So Donald Trump situation where he's imposing a lot of tariffs. So one way that you can avoid paying the tariff, so are you guys aware in terms of how the tariff works? So if you want to export anything into the US, so if you're from a country outside, if you're from a country, not a US country, you're importing into the US, the Trump administration is now putting tariffs on all those products that's imported into the US. So one way you can avoid that is by actually setting up your company within US itself and producing the products within US. So then that is a way of getting around the tariffs, right? So you see that some companies are already doing that. I know that in one of the companies in Australia that I think is VISI that produces paper works, they set up plants within the US itself and produce the paper products, right? Like the packaging products within the US. That's one way of, I don't think that was the main reason for them to avoid the tariffs, but that is one way you can avoid a tariff if you have the factory set up within the country. Another one is in terms of avoiding the tax difference. And I've mentioned this a couple of weeks ago with the Apple situation, right? So here with the Apple situation, the Apple uses this thing called a transfer pricing, which allows them to avoid the tax. So how does the transfer pricing works? So they use, and I think we talked about this a few weeks ago about using Ireland, right? So what they do is when they sell the products in Australia, for example, they charge the Australian stores a high price for actually doing the supply. So when your cost of goods in Australia for the Apple products is high, you sell it to the consumer. That means locally you don't make as much profit. Right? Does that make sense? Because imagine I'm an Apple store in Canberra. I get my products from Ireland, and the cost itself of, let's say, an Apple phone is $1,500. Right? So that's the cost that my head office, Ireland, actually charges me. I can only sell it for $1,600, for example. I only make $100 profit. But in true fact, the manufacturing cost of the phone is much lower than $1,500. But my head office charges me $1,500. So the profit that I make in Australia itself is quite low, but the overall profit is quite high to Apple. But that profit is actually booked somewhere else in Ireland, where they have a very low tax being charged on Apple, right? So that is the transfer pricing technique or strategy that Apple uses to avoid the tax differences, all right? So Apple would then set up their subsidiary in Ireland to actually allow them to do that. So you can see how that multinational corporation structure works for them, okay? All right, so these are some of the reasons why a corporation would operate in multiple countries in terms of setting their operations in different parts of the world. Okay, what are some of the issues involved? So here, remember, I said we need to always relate these issues to corporate governance, right? So here, we can think about the human rights and the environmental issues, so that there are typically lower human rights and environmental standards in some of these countries. For example, in India, if we set up a factory in India, the human rights and the operating standards will be lower in India than in our home country, for example. Right? So what does that mean in terms of governance issues? Right? Also, in some of these countries, these companies can actually have a lot of influence on the politicians and the government due to their power, the economic power, right? Because these companies or these corporations are very large. If they're not happy, they'll pull the company out from that country, and the country could have consequences in terms of the economic development, right? So again, if they have a lot of influence in the politicians and the government, what does that mean in terms of governance issues? That means the government is going to be less able to take the company to task if they violate, for example, environmental issue, if they violate investor issues, right? If they violate on social issues. Because they have a lot of power, then these government and politicians are going to be less able to do anything about it, right? The last point relates to the tax issue, right? So with the multinational, again, they have been criticized all around the world, especially in some of the developed countries, about the tax that they pay. And they pay extremely low taxes, even though they extract a lot of revenue from those countries, right? Again, take, for example, Apple. The way they've structured it, it means that even though they sell the products to Australian consumers, Apple itself doesn't pay a lot of tax in Australia because of the way the transfer pricing system works for them, right? So here, you need to think, if they don't pay enough tax, what does that mean in terms of the country that they operate in, right? Because they use all the infrastructure within the country, but they don't actually help to sustain the infrastructure. So there are some issues with that as well. Okay, so that's issue with the multinational corporations. So the next thing I want to talk about is cross-listing, right? So what is cross-listing? So the very simple definition of cross-listing is that it involves companies that trade on the stock exchange of their home country and also on a stock exchange or stock exchanges, because it can be multiple, in another country, right? Cross typically means to list on somewhere else, on a dual listing or a multiple listing. So here an example that I've got is the Sony Corporation. So I just took this snapshot, I think 2 days ago or yesterday, to look at the share price of Sony over a 6 months period. Right? So you can see this left-hand side here, this is Sony traded on the New York Stock Exchange, and this is Sony here traded on the Tokyo Stock Exchange. It's essentially the same underlying company, right? But you will see that the share price fluctuate very similarly, but not exactly the same. Okay, why do you think it's not exactly the same? The market is different, yes, but the underlying fundamentals of the company is essentially the same, right? So we should expect the share price fluctuation to be very similar, which it is, but not exactly identical. What is the currency that's traded in? This one on New York Stock Exchange is traded as, can you see the, I know it's a little bit small on the printout. This is USD, and what's this one here? Japanese yen. So the differences in the fluctuation could be because of the currency exchange, right? Because one is traded in the yen and the other one is traded on US, okay? But they're very similar, right? Because they have to be, because they're the same company. So then you would think, okay, why would a corporation want to cross-list, right? So what are the reasons for doing so? So we're going to come to that. Because if they're really giving us the same exposure to the same company, why do we need to have Sony listed on the New York Stock Exchange and on the Tokyo Stock Exchange at the same time, right? Okay, so what are the reasons for cross-listing? So some of these reasons are what I've read and gathered from the newspaper articles and also academic work and also professional press. Some of them are viewed to be untrue. Okay, so it's what people think that the benefits are, but I'll show you later that research has shown that they are not proven to be true or not entirely true. Okay, so these are some of the reasons. So they gain exposure and access to more capital, right? So this is when they want to do capital raising on new issues. So that means if a company is listed on, take for example Sony, listed on the Tokyo Stock Exchange, and if they wanted to gain more exposure and access to more capital, they might say, I'll go to New York and raise more capital there because there's another pool of investors there that I can raise the funds from, right? So this is typically a textbook answer, right? A textbook will say that this is what the companies do. And some of the research evidence has shown that this is not true because when they cross-list, they don't actually raise additional capital, okay? So they don't go to another country to actually raise more capital there. Not all firms do that when they cross-list. So I'll talk about what type of companies from what type of countries you'll find that this answer is more true than others, okay? So this is gaining exposure and access to more capital. The other one is where they say, oh, if I cross-list down and I'm going to have more market liquidity. So what do we know is market liquidity? What's liquidity? Sufficient. So think this is market liquidity, okay? So it's not liquidity within the firm itself. So what do we mean by market liquidity? Very good. Trading, right? So it's about trading. So we think it's about trading. So that means if we have market liquidity, meaning that there's more people trading on this stock, okay? So why is that important? Right. So when we have a stock that we find it's easy to buy and sell out of, right? Will you be more willing to actually invest in this company than in a company that is very difficult to get in and out of? You will be more willing, right, to buy or to invest in a company that you can trade in and out of. So if you're more willing, what would be your expected rate of return expected from this company? Low or higher? So you think, okay, let's think. If this stock is easy to trade in and out of, will I be more willing to lend them the money at a cheaper rate than a company that is more difficult to trade in? Cheaper, right? So that means the cost of capital itself will be lower for one that has a high market liquidity, right? So here we're thinking, okay, if we have cross-listing, then perhaps we have more market liquidity and we can decrease the cost of capital. All right? Okay, is this true? Again, it depends, right? It depends on the type of country that you're from, so we're going to look at some evidence for that. The third one is political signaling. So what political signaling is about is really indicating that you are there in that country for a long haul, right? So the company is in the country for the long haul, and it's not that you're just going into the country and exploiting the country for their resources, for example, and then you're getting out. Right? So if you're actually operating or cross-listed in that country, you're meaning to be there for a little while. You're willing to also pay the local taxes, right, because you're listed in that country. You're willing also to share your profits with the locals, because you're allowing the locals to invest in your company, right? So this is all political signaling in terms of the company is not just there to exploit the country, all right? So some mining companies do that. They do the political signaling. So if they mine in, let's say, an Australian company that mines in Canada, they will try and list in Canada to allow Canadians to also own its shares, right? So you're signaling that you're participating in that country. Okay, that's known as political signaling. Another one that is related to political signaling is this improving of the corporate governance structure, right? Also known as bonding here. So what this is about in terms of improving the structure of the corporate governance is, imagine you are a company that is being incorporated in, let's say, in Indonesia, right? where the corporate governance is probably not ideal, and then you say, I am going to list on the US. So if I list on the US, then what I need to do is I have a whole lot of regulation, the US regulation I have to obey by. So that means the corporate governance of my company has to, what do we have to do? Improve it or just keep it the same? Improve, right? Because the US will have more stricter corporate governance sort of requirements. For example, SOX, right? The requirements of SOX. So here, what you do is when you list on another country, you're actually doing this thing called bonding. Because what you do is you then say, I'm bonding, I'm showing that my corporate governance has to improve. It's got to be like the typical company in the US, because now I'm listed in the US. So I'm actually better than the other companies that has been started out in Indonesia, for example. Okay? So that's what we know is known by investor protection in terms of bonding, improving on the corporate governance of the company. Okay. Another point is in terms of information disclosure. Because of the requirements in different countries, if I cross-list in a different country and if they have stricter disclosure rules, then what I have to do is disclose more information. And again, disclosing more information should lead to a decrease in the cost of capital. All right? Okay, so those are the main reasons. There are some additional reasons that I've got down here. These are the two parts. This refers to the labor market idea. So if I cross-list, then I'm able to attract more and better talent. Because if I'm listed in another country, my name is known out there. People might want to come and work for me, okay, because they know who I am. And also the last point, if I'm listed in a different country, it could help to improve the reputation of the company. And this might be for marketing purposes. So if you're trying to sell the products, you might be better off listing somewhere else so that your name is also known to that particular country. Right. Okay. So those are the reasons. So that's the labor market consideration. Okay. Okay, so what are the mechanisms in terms of for cross-listing? How do we achieve cross-listing, right? So there's in fact a number of ways you can go about doing this. There are some ways which are more well used, and in particular the third one is quite well used, this ADR idea. So the first way of cross-listing is where we do a new issue. So we raise capital from in another country. So if we're listed on, let's say, the Tokyo Stock Exchange, like Sony, we want to do another listing in the US. We go to the US, we do a full prospectus, apply through the SEC, we list the Sony shares there, and we actually get new capital in. This is not very common, this new issue for cross-listing. Okay, this is not common. Another one is a transfer, where you take the shares from the primary market and you take it to another market. So you take the shares from the Japanese market and then you actually register them in the New York Stock Exchange. Again, that is not as common. The third one is the most common. It's known as American Depository Receipts or Deposit Receipts, and doesn't have to be American. This is how it's used to start. So in the past, I think this was in the 1970s, where technology is not quite there yet. For Americans to invest in a non-US stock, it was very troublesome. They have to face currency exchange. They have to register, the investors themselves have to register on a different stock exchange in another country. So they find that investing in foreign companies is quite hard. So they started this idea on American deposit receipts. We'll talk about the mechanism of American deposit receipts later, but that started out in the US. Now you can also have deposit receipts in Europe, okay? And I think also in some of the Asian countries you can do that as well using deposit receipts. So we'll talk about this structure in a bit. And the last one is using foreign subsidies. So this itself is not officially cross-listing, but it helps you achieve the sort of facility or benefits that you can get from cross-listing. So what is foreign subsidies? So essentially, you go and set up another company somewhere else. So if you are a Chinese company, you set up another company, your subsidiary, in, let's say, in Singapore, and it's listed on the Singapore Stock Exchange. So it is not a cross-list, right, but it's a subsidiary of your organization. So you can achieve very similar benefits as the cross-listing, but obviously it's different, right, because it's not exactly the same company. Okay, so we're going to talk a little bit more about the American deposit receipts. So as I said, this is the most common way of achieving a cross-listing. There are many ADRs, and the ones that we are familiar with are companies such as Siemens of Germany, Toyota, Honda of Japan, UBS of Switzerland, Shell of the UK, and you might be familiar with, is it Baidu of China? And what's another one that we can think of that is actually cross-listed in, they wanted to be, actually, are they cross-listed? I think they wanted to be cross-listed on Hong Kong Stock Exchange, and then they were rejected. Huh? No, I don't know whether Xiaoming was one of those, but I think Alibaba was one of the ones that they got rejected by the Hong Kong Stock Exchange, but they listed on the New York Stock Exchange, right? So anyway, these are some of the companies that we're familiar with in terms of cross-listing. Okay, so how does, sorry, not cross-listing, they're using ADRs, right? So how does the ADRs actually work? Okay, so what you have is you have the foreign company, and the foreign company will have shares, right, that's traded on a different stock exchange. Let's say, for example, they're traded on the on Australian Stock Exchange. So then what an investment bank would do, they would buy some of these shares from the Australian Stock Exchange. They'll buy some of these shares and they will actually register them with the foreign bank, all right? Then this foreign bank, the US bank, in the case of the American deposit receipts, the US bank would then issue out these ADRs, and they can combine some of these shares together. So for example, if they buy the BHP shares, they can combine 10 BHP shares into one ADR, and then that ADR is then on-sold to the ADR buyers. So these are the holders of the ADRs, right? So here, this ADR buyers will buy into this. So imagine the 10 BHP shares is combined to one ADR. This one ADR will be denoted in the US dollars and will be sold to those buyers of the ADR. So the US bank that's in the middle will then pass on any dividends that is being paid out by BHP to the ADR buyers, right? So they're acting as the intermediary. So they will take care of all the dividend payment, and they will take care of all the currency transactions as well, right? So that's passed on to the ADR buyers. So these ADR buyers do not have to worry about actually registering in the foreign country to buy the company, right? Because they're buying and transacting all within the US dollar, okay? So this is known as ADR. There are many different levels of ADR. In fact, not many. There are 3 main levels of ADRs. So there's level 1, 2, and 3. So how are they different? So level 1 ADR is the least, requires the least reporting requirements because they are traded over the counter. What do we mean by traded over the counter? We have a counter, right? It's traded over the counter. It means that there has to be interaction between the buyer and the seller. It's not done on a stock exchange where the buyer and seller really don't know each other, okay? So over the counter, you have to have, there's no formal exchange where it's traded. So that's level 1. So you can see because it's done over the counter, right, there's less reporting requirements. Whereas level 2, this is where they're traded on an exchange. Here, the company must file a registration statement with SEC, that's the regulator, okay, and they have to file also their annual report in accordance to the US GAAP, right, or the IFRS standards. If they do it on the US IFRS standards, they actually have to do a reconciliation to the US GAAP, right? So they can file the financial statements according to IFRS if that's what they were using in their home country, but they have to do a reconciliation. So this is stricter in terms of level 2, right? Because you have to do the reporting, you have to file your registration, but this allows you to trade on the exchange. Level 3 ADR, sorry for the typo, it should be ADR here. Level 3 ADR, this is where you actually use the ADR to raise more capital. So remember I said before that we find cross-listing is very seldom for stocks that are cross-listed to actually raise new capital. But if you wanted to, you can do that using a level 3 ADRs, right? So you can float using an ADR, raising capital from the American investors. Okay, so these are the 3 different levels, and as I said, there are differences in terms of the reporting requirements. Level 1 is the most lax. Level 2 and 3 are more restrictive in terms of what you need to file. Okay. Okay. So level 2 is the majority in terms of the type of ADRs that we see. Okay. It's more rare to see level 3 and level 1. Okay. So what are the downsides of cross-listing? Okay, so now we've talked about the reasons for cross-listing. We say, wow, there seems to be a lot of benefits, right, that we can get from cross-listing. So what are some of the downsides? So from looking at the ADRs, we already know if you wanted to raise capital from the American investors, or if you wanted to trade on the exchange, you have more reporting requirements, right? So here, the stock exchange requirements, if you're going to cross-list, you have to obey the stock exchange requirements. So some stock exchange are more restrictive than others. So some will require things on information disclosure. For example, in Australia, have you heard of this thing called continuous disclosure? Yes? Okay. Greg might have talked to you about this. So do we know what's continuous disclosure? Chloe nodded her head. So what do you know about? Okay. Correct. That's right. So in Australia, if you have information and it's material or significant, will affect the share price, materially affect the share price, I think that's the term, then you have to disclose it. Okay? So, and you have to disclose it when you are aware of that information, right? So, that is an additional requirement in terms of cross-listing, for example, in Australia. So if a company wants to cross-list in Australia, and they're listed also, let's say, on the New Zealand Stock Exchange and they cross-list on the Australian Stock Exchange, then they have to meet that continuous disclosure requirement. Right? Unfortunately, I think New Zealand Stock Exchange also has a continuous disclosure requirement because they're very similar. But some of these disclosure requirements can be different across stock exchanges, so we need to bear in mind what they are. We also have differences in terms of liquidity requirements. Some stock exchanges require that a stock have a certain level of trading. If they don't, then they delist them. Right? So you think, oh wow, so if I were to list on another stock exchange, I need to make sure that there's enough trading of my stock. Right? If there's not enough, then I have to delist. There are also requirements in terms of the securities regulator. So the US, for example, if you are cross-listed on the US, you have to use the SEC approved or SEC registered auditors. Right? So if you don't use SEC registered auditors, then you may be forced to actually take your stock off the US stock exchanges. In the US also, we know that there are requirements for the directors and the top management in terms of their responsibility under SOX, right? They have to sign a declaration in terms of the financial statements and disclosures. So that is actually different for Australia, right? So in Australia, they don't have to actually sign those requirements. So we will talk a little bit more in terms of the requirements next week, but if there are differences, then you need to know, well, is there an extra requirement, right? There are also additional financial reporting requirements. You have to use the country's accounting reporting rules if you're going to be listed in that particular country. Right, so all these things essentially add up to one word, right? It adds to cost. Very good, right? So this thing adds to the cost. So we need to think about the cost of disclosure and compliance of these requirements. Right? So these requirements really have some downsides in terms of cross-listing. So you need to think, what are the benefits that I get versus what these costs are, right? Okay. So what does the research tell us then in terms of the benefits? Okay, so we go back to a very early paper, 2002. This is done by Baker and Kent, and this was published in the Journal of Financial and Quantitative Analysis. So what they did in this study was they looked at companies that listed on the New York Stock Exchange and the London Stock Exchange. So they cross-list, right? So they say, well, if you cross-list, do you get any benefit? So New York Stock Exchange, London Stock Exchange, which one do you think the cost is higher, New York or London? Have a guess. New York, right, excellent. So New York was higher. So if New York was higher, what do you think the benefits should be? Where should you have more benefits? Should be New York, right? Okay, so that's sort of sensible. We should be thinking, okay, if it's more costly to list on New York, and we do list on New York, cross-list on New York, we should actually see some benefits from New York compared to London. We know there are both costs involved, so there should be some benefits, right? So do we see that? So that's really the question that they ask in this paper. So they studied some international firms that listed their stocks on New York Stock Exchange and London Stock Exchange, and what they find is that there is a significant increase in visibility. When they say increase in visibility, it means the number of analyst coverage is greater, so increased. Also, the media coverage is greater. So they looked at the Wall Street Journal, whether they follow these companies, and they see, wow, there's more coverage, more news articles about this. And they find that associated with that is a decrease in the cost of capital, equity capital. Wow, those were all the reasons that we listed, right, before. So it seems that we have increased visibility, we have then subsequently a reduction in cost of equity capital, okay? So that's what Baker and Kent found. That's 2002. Then in a later study, I think this was done in 2008, right? And it's done by a consulting firm, McKinsey. You would have heard of them. It's a famous management consulting firm. They did a study, and what they did was they looked at companies that cross-list, and they say they were more skeptical because they say, well, we've actually seen more and more companies becoming non-cross-listed, so they drop off the cross-listing. So they say, well, why do companies drop off from their cross-listing? It must be due to some sort of cost involved and the benefits outweighing, not outweighing the cost, or the cost outweighing the benefits, right? So here, what they do is they say, well, whatever benefits companies might once have derived from cross-listing, our analysis shows that in general, there's few gains, but significant costs. But they qualify that statement by saying, at least for most companies in the developed markets of Australia, Europe, and Japan. So they're saying, if you're listed in Australia, Europe, Japan, you might get less benefits from cross-listing, right? And then they compared this to companies from the emerging world, right, from the emerging markets. And what they find here is that the cross-listed shares of the emerging countries represent as much as 1/3 of their total trading volume. So what do they mean by that? So that means if you look at a company that is from an emerging country, the trading that is done on the cross-listed countries such as the New York Stock Exchange is about 1/3 of their trading in the home country, which is substantial. For the developed countries, that proportion is a lot smaller. That means the bulk of the trading is still done in the home country, not in the cross-listed place, right? So this is for the emerging countries. They also say that for these emerging countries, these companies that cross-list, they are successful in getting raising capital in terms of the new issues. Whereas for those developed countries, companies, they don't actually get that benefit in terms of raising capital, right? So what this suggests to us is that by cross-listing gives you access to capital. You know what I said about the textbook answer initially? It's a textbook answer, probably not true for the developed countries, but for the emerging countries, this is probably okay in terms of allowing them to access capital. And the last part, which is probably the most important part, is the talk about, or this discussion about the corporate governance. So they say that compliance with the more stringent US and UK corporate governance requirements generate could generate real benefits for the shareholders. So what they're saying here is that it's not about the access to capital, it's not about the cost of capital necessarily that we get, but really is the corporate governance, the bonding issue, and that we can get real benefits for the shareholders in terms of protection for the shareholders, right? So here they do say, well, we still see some cross-listing happening, and it's probably the companies from the emerging countries that are getting the benefits, but also we are getting the benefits from the corporate governance improvements, okay? All right. Okay, we might take a break. Let's take a 10-minute break, and then we'll start again at 3:05, okay? Okay, wake up, wake up. Let's get started again. Right, so we've talked about cross-listings and we've talked about multinational corporations, right? The concepts are fairly simple. So what we focus on is what are those things, what are the benefits of doing cross-listing, having a multinational company, and then we talk about some of the issues that involve, right? So here we're going to start shifting gear a little bit and talk about internationalization of capital markets. What does that mean, having internationalization? And also, what are the trends that we observe? Right? So internationalization just means that corporations are actually having their stocks traded in different parts of the world, meaning that you have more cross-listing, also meaning that there is more multinational corporations that exist. So before we actually talk about that in terms of internationalization, let's have a think about capital markets, right? So capital markets, so a lot of you will be familiar with this. A capital market exists to actually allow people with surplus funds or entities with surplus funds to pass those surplus funds to entities that are shorter funds, right? So if you have a very efficient market, then what you have is the people with the surplus funds will pass the funds onto the people or the entities that need it most and that can use it most efficiently, meaning that they will get the maximum benefit from it, right? So that's really what the capital market is. So as I define here, it's a system in which entities with surplus funds transfer those funds to entities that need funds. That's what it is. When we look at international equity markets, this is where all the shares or the ownership of the company gets dispersed outside the issuing corporation's country of incorporation. So meaning here that BHP, for example, can be owned by Australians, but can also be owned by people in London and also New York because they are cross-listed in a number of different places, right? So that's internationalization. So when we have a market that's very integrated, this term integrated, what it means is that then the funds between different countries or between different markets are allowed to move very freely, right? So when we have an integrated market, funds in Australia could move very easily to another country, okay, and vice versa. The funds can move from another country into Australia if the funds are required. So all that here, what we're talking about internationalization and integrated market, is just that funds flow easily across markets, across countries. Okay, so why might we see internationalization of capital markets? So why might we see things as cross-listed companies? Why might we see multinational corporations? So we see that because of these three reasons. These three reasons that are put down. These things stimulate the internationalization of capital markets. And the first one is economic development. And that's primarily the reason that we see internationalization of capital markets. We talk about access to funds and all that, right, before. But the access to funds is to fund or to help the economic development. So what do we mean by economic development? So economic development is allowing a country to prosper, to grow, right? So if you wanted to grow, then you need to think, okay, do I need to tap on the international markets to actually help me grow, right? So that's the economic development. Then we have a second reason, which is the privatization. So what do we mean by privatization? So if you take Australia, for example, there are a number of companies in Australia that were government-owned before. So companies such as Commonwealth Bank, which one? Qantas, very good. And Telstra, that's good. Telstra is a bad example because I own Telstra shares when they were privatized, but they don't do very well even till now. But yes, those companies are the ones that were privatized, okay, because the companies want to sell them. So you think, government wants to sell them. So government wants to sell them. Why couldn't they sell them just to Australian shareholders? Why would privatization actually stimulate internationalization of capital markets? it is actually riskier, so that means we would not want to do internationalization, right? It's true. But here, privatization actually pushes us towards internationalization of capital markets, right? So remember what we said before, the very first point, and we said, oh, that's a textbook answer. What was that? The textbook answer was? Raise the capital. So if I am the Australian government and I'm trying to sell Telstra, and it's a big company that I'm trying to sell, if I just sold it to the Australian people, there might not be enough funds, right, to soak up to buy what I'm floating. So the privatization here actually allows us to take the resource out of the government hands into private hands, but we need funds from externally, from the international capital markets, to actually help us float the company, right? So if we don't have access to institutional investors, for example, from the US, from Singapore, from elsewhere in parts of the world, then we might not be able to actually get the funds out by selling the company internally, right? So privatization has actually helped to stimulate internationalization as well. And then the last one is in terms of technology. So technology, we know, allows us to trade not just Australian shares. If we're in Australia, we can actually buy and sell shares in the US, in China, yes, right, as long as you have connection into those markets, right? So technology really has changed the capital markets in terms of granting us access, and it has helped us in terms of internationalization of capital markets. Okay. Technology has also helped in terms of information flow as well, don't forget that, right? So technology has allowed us to know more about how a company is doing, for example, in the US when we're here in Australia, because we have access to the information, right, through technology. So these are the things that stimulate the internationalization of capital markets. And Chloe is right, there's actually costs involved, right, in terms of internationalization. So what might be the costs involved in terms of internationalization? So under the economic development, I said that was a primary driver for internationalization. So economic development, you can think about if we want to help a country grow, we need to allow it to be internationalized. So we need to allow funds to flow in and out of the market. So for example, Australia floated the Australian dollar sometime a few decades ago. And we did that because it allows us now to trade more freely, right, with other countries. So that's helped to stimulate economic development. But what do you think would be a cost involved of doing that? So by allowing our currency to be floated, and we're not big, right? Australia is not that big compared to US. In fact, we're quite small compared to the US. So what do you think would be a cost allowing our currency to be floated so that we're now more internationalized? So do you think currency stays constant? It can fluctuate, right? So then you think, how does a currency fluctuate? Is by? Currency will fluctuate. Of course, interest rate will cause currency to fluctuate. If the Reserve Bank changes the interest rate, then it will, if they decrease interest rate, currency typically drop in terms of value, right? So that's all economics. But how else can currency fluctuate? Natural disaster, good, okay. So that's not really a cost, right? Because natural disaster happens because natural disaster. But how else can currency fluctuate? Trade war. Government policy, yes, right? But trade war, or you can have traders trading in it, right? So we know that demand and supply typically can move value of assets. So demand and supply for currencies can also cause the currency to fluctuate. So if you have traders that are targeting a particular currency, it can cause the currency to fluctuate in ways that you don't want it to, right? So you can so internationalization can expose the particular capital markets to traders' actions, right? So there are costs involved. So if you have a read of Malaysian currency, for example, Malaysia was quite against floating their currency, and at one stage I think they were thinking of taking their currency out. Allowing to float, that was because they think that it can be manipulated. Okay, So there are costs involved in terms of internationalizing capital markets. Okay, so what we will talk about next is some of the country differences in capital markets. What we will focus on today is look at some of the characteristics. So we have talked about, we will talk about some of the development in these capital markets and the risk involved and the characteristics of corporations listed in the country. So that's in the next few slides. Next week, we'll look at the local characteristics and expectation of investors, right? And we'll look at the regulatory systems and the cultural norms. So these are the ones that I start. So the ones that will be discussed next week, okay, in week 12. And also in your textbook, chapter 11 and 12, they're quite long. I think they're about 120 pages long for those two chapters. They cover the local characteristics and regulatory systems of various countries. So next week we'll go through those, but I'll give you a summary of the countries that we want to focus on. Predominantly we want to look at the US, but we will also look at some of the we will look at UK and we will look at some of the Asian countries as well. Okay, so that's for next week. But now what we want to do is focus on the capital markets in terms of the characteristics of the capital markets and how they have changed over time and how they vary across different countries. So a lot of the material that I'm using are taken out from this chapter 10 of this handbook. You can get a copy of this if you go through the ANU library. So just on the web, you can download it. In fact, what I might do is I'll put it on Wattle so you can have access to it. So this particular chapter is on the evolution of ownership and control around the world. There's only a few graphs and tables that I want to focus on in here, but it shows you how the capital markets have changed over time. So you just need to get a general idea of what are the changes and how some countries are different from others. Okay. So figure 1 in that particular chapter looks at the number of listed companies in 3 countries and also generally in the world, right, stock markets. So this is over 1990 to 2012. Not very long, right? So remember, this is from 1990. I'll show you a table later that extends much more before 1990. So we'll go back to the early 1900s to show how it's changed. So this is only within how many years? 22 years, right? It's quite short. So what you see here is that the full line, the solid line, is at the bottom. This is for Germany. Then you have the next line here. This is for the world. Okay, so how do they define the world? Everyone. That's essentially what this. But they don't actually tell us in the chapter exactly what the components are for the world. But we're just going to assume that it's everyone else, every other country. Then you have this longer dotted line. This is the US, right? And then this shorter dotted line up here, this is the UK. All right, so what does this tell us? This tells us the number of listed firms. And then when you look on the left-hand side, it's 10, 20, 30, 40. You think, well, what's this number of listed firms? Read that very carefully in the description. It says these are the number of domestically incorporated companies listed on a country's stock exchange divided by the country's population in millions. So it's like a per capita way of looking at it. Okay? So given the population, how many firms do you have listed on the country's stock exchange? So when we look at the world, which is this dotted line in the middle, second from the bottom, this is showing us it's about how many companies per million people? About 10, right? So that's about 10 there. And it's sort of stable. It fluctuates a little bit, but it doesn't go very far. So then you look at the line right on the top. This is UK. It goes up a little bit to about 2000 or 1999, and then it starts coming down. So that means the number of listed companies per million people is actually declining for the UK past the 2000 period. Before the 2000, it seems to be on a slight increase. Same for the US. It has a similar trend, right? It goes up a little bit before the 2000, and after 2000, it starts coming down. Then you look at Germany, which is this solid line at the bottom. Germany is quite low in terms of number of firms per million people, right? But it has increased a little bit from 1990 to 2000. and then it sort of plateaus, stays, comes down a little bit, but it's fairly stable, right? Okay, so, and then if you look at the average, which is for the world, as I said, it's fairly constant at about 10. So then you have to start thinking, what's actually happening in this period around the world? So if the US and the UK is declining in terms of the number of firms per capita, that means other parts of the world, it must be increasing, right, to compensate it so that it's flatter in terms of average for the world. So we know that in the UK, US, it's coming down. Well, why is it coming down? Right? What are the reasons for why there are less companies listed on those, in those countries? In the paper, it talks about consolidation. It talks about mergers and acquisition. So it must be occurring where companies are being combined, is being merged together. There's consolidation of companies within those countries. Right? But not so in other parts of the world, because we are observing that the average for the world is fairly flat, it's fairly constant. So that's interesting, right? So there's the trend in terms of what we observe can be explained in terms of the corporate activities in the world, right? So in particular in the UK and the US. Then in that particular chapter, they also refer to other research that has been done, and they refer to this paper by Rajan and Zingalis, 2003. So Rajan and Zingalis, it's more of a theoretical paper. What they do is they examine the state of development of the financial sector, and they propose a theory to try and explain why we see differences across different countries, right? We don't want to look at the theory. What we want to do is we want to look at some of the numbers that they've got in terms of the paper. So they examine the number of domestic listed companies per million of population for selected countries over the period 1913 to 1999. So they look at a period that is extend before this period, right? They look at 1913 on to 1999, right? So they've got a slightly overlap period, but they have a much longer time period before then. Okay, so this allows us to look at some history, right? So this is the table from the paper that is interesting, table 5. Right. So they say, okay, so we're really producing the similar statistics as the Franks and Meyer paper, Franks and Meyer chapter, which is this one that I've taken out from, right? So they say we have similar numbers, but we extend it before, right, 1913 to 1999. So when we look at the US, in fact, you see that from 1913, the number of companies per million people is at 4 companies. And then it's grown to about 26, right? So remember the trend that we saw in the Franks and Meyer paper where there's a little bit of decline in 2000? Well, we don't see that here because they don't have the data, right? But we can see that there's the increase in the 1990 to 1999, right? Just a slight increase. But you can see the US has increased from the past, but then in the later period from the Franks and Meyer paper, that this has declined a little bit. So that's the US. So they're averaging at about in the 20s for the US, 20 company per million people. Then have a look at countries such as Australia and Canada. Wow, Australia and Canada seems to have a lot more companies than the US per million people. Is Australia bigger than the US? No. Okay, so it's not. So why is that the case that we have more companies per million people than the US? Why do you think? Huh? Population? But we have a smaller population here. Are you saying that, what are we saying about population in Australia? Probably not the population, right? So how else can we explain the difference? Australia and Canada is very similar, right? If you look at don't just look at 1999 because that's where you have the dot-com boom at that time, right? So the increase in Canada from 43 to 130, I think it's due to the technology stocks as well around here. But even if you just look at 1990 and beyond, before, you can see Australia and Canada are quite similar, right? We have about 50 firms per million people. What's the characteristics that we share with Canada, Australia share with Canada. What type of industry do we have here? Natural resources, mining companies. Are they big companies or small companies? Hannah says small, right? In fact, Hannah's quite right. They're very small. So we have a lot of very small companies that are listed on the Australian Stock Exchange. The market capitalization of these guys are so small when you compare it to the US companies. Right? So that's why we have so many listed companies, because they are small, right, compared to the US. So Canada is the same. They have a lot of mining companies, right? And given the population, it's interesting that they, similar to Australia, we have so much more firms per million people. Okay, so here what we're highlighting is that the type of companies that you have in the country does affect in terms of the listing, right, the capital market. Then you have a look at one of these countries, Sweden. Sweden is a country where they have a lot of family-owned companies. Okay, they're privately owned. So here you can see that the number of firms per capital or per million people is smaller, again, compared to Australia and Canada, right? But over time, it seems that on average it's greater than US, but it hasn't grown as much as the US when you look at at least the 1990 time period, okay? Okay, so we know then country differences in terms of the industry, the history in terms of the type of ownership is going to affect the capital market, right? So that's what we see here. So then in this other paper by Frank Meyer and Rossi, they looked at the ownership structure. And here they look in particularly at the UK ownership structure over the 20th century, right? So when we talk about ownership structure, we mean that when we look into a company, who are the people that own the stocks, right? And do they own a lot of the stocks, or do they own, and is it dispersed in terms of the ownership? So the way they study this is by looking at what's the minimum number of shareholders required to exercise control, right? So they set the control as 25%. So imagine that we are all shareholders of company A. So the question is, how many shareholders do we need to combine together so that we have a control ownership of at least 25%, right? So here, if I say that I own 25% or 30% of the company, then you only really need one shareholder to exercise control, right? But if, let's say, we need 20 of us to combine together to own 25%, that means it's more dispersed, right? Because each of us own smaller pieces, and then we have to have 25 of us combined together to actually have that control. So what they do is they study the dispersion of the control across time. So from 1900 to 2000. So panel A, they use a sample that is of ownership from, starting from 1900. So what you observe here is in 1900, you only need 2.35 investors to combine together to own 25%, to exercise or to exert 25% of control. When you go to 2000, you actually need 48.45 investors. So you need to gather 48 investors together. That means it's now more dispersed in terms of ownership, right? So they say, wow, so we can see over time it's become more dispersed. So the question is, why has it become more dispersed? Why are people owning more shares, right? And what is the implication in terms of shareholder right protection? So the UK is particularly interesting in that they have actually quite weak shareholder protection, right, historically. It has changed, but it's particularly weak. So it's interesting that this trend is actually observed in the UK. They also look at panel B. They look at just a sample in the later period. So this 1960 sample comprises of a smaller data set of companies that existed in 1960. And they say, oh, it's actually not just a phenomenon that's limited to the later companies, but it's a phenomenon that we observe generally over time. So I don't want you to dwell too much on this, but what you need to get a sense of is that there has been changes across time, right? Things have changed. People are owning more shares, or more people are owning shares, and as a result, the ownership is getting more dispersed. Well, what does that mean in terms of corporate governance then? Okay, it means that there's less people with controlling rights, so they're smaller. Does that mean that we have to offer them more protection in terms of regulation and requirements, right? Okay, so here, just to summarize, in terms of differences in ownership, we do observe different ownership and control structure in terms of public companies. We talked about Sweden, where there's more family control. That's why you have less listed companies. We can see that in the UK, the ownership structure has changed. There's more dispersed in terms of ownership as well. We then see that the structures in countries has also changed over time. So here you can look at, for example, Germany. I did show you that Germany from 1990 has increased in terms of number of listed firms, right, until 2000 and declined, okay, a little bit but quite flat. So compared to the world, Germany has less number of listed companies, but we do see this increase, right, since 1990 to 2000. Then you need to question, why did it change? Why was there more listed companies? In fact, it almost doubled, right, from 1990 to 2000 over the 10 years. Why did it double? What happened in 1990 in Germany? You were born, right? Some of you. Yes, 1990. What happened in 1990 in Germany? European Union, very good. In particular, in Germany, what happened in Germany? There's something to do with wall. Huh? Combined, right? So East Germany and West Germany actually combined. So there's a unification. So that happened in 1990. So there must be some changes in terms of the structure of the capital market at that time, right? Which allow the number of listed firms to increase over that period of time. Okay. We know that in 2000 you have the tech crash. So things would have changed, would have declined. But definitely the increase here would have to be due to the structure in the country that has changed. So here, what we're trying to get at is there are different structures in different countries, and it has changed over time, and it must be due to some of the regulation within those countries. Okay, last slide. Last thing I want to talk about is this interjurisdiction conflict, right? So now we can think internationalization means that you can have companies that's cross-listed, or they are operating in different countries. So where does this conflict come from, right? So how can conflict emerge in terms of the regulation reach, in terms of the corporate activities? Where are the sources of these conflict? So I'm going to give you one example, and then you can read a little bit more about this for the workshop next week. So the example that I want to use is about Chinese companies and companies that are listed that are from Hong Kong, right? And in fact, it's not just confined to Chinese and Hong Kong companies, but also to companies in Europe, like Belgium. So if I want to cross-list in the US has a requirement in that I have to appoint an auditor that is SEC registered. And also because of SOX, Sarbanes-Oxley Act, the government, PCAOB, or the auditor regulator, right? The regulatory board of the auditors will need access to the audit papers. So they have a right, and they're actually quite forceful, PCAOB in the US. They will go to the auditor and say, we want the audit papers, and the auditors will have to give it to them. So when we mean the audit papers, it means that when the auditors check the accounts of the customers, they keep those audit papers. They have to allow PCAOB access to those papers. So when you are cross-listed in the US, you have to use a registered auditor, and you have to allow the auditor to pass on those information to PCAOB. So imagine a company, a Chinese company that's cross-listed in the US. Now they have to use a SEC-approved auditor, but they also have to allow access to their accounts and their papers. You must be aware, some of you would be aware of the Chinese requirement, right? So the Chinese requirement is that the auditors cannot pass on those papers. So, and the papers have to be kept in private. So here, what you can see is a conflict between the two jurisdictions. In the US, if I'm listed in the US, my auditors need to give access to those papers to the PCAOB. But because I'm a Chinese incorporated company, I need to obey the Chinese regulation, and it tells me that I cannot give access to the US regulator. Right? And this is particularly so where a lot of the Chinese company would have an auditor in the US, but the auditor will work together with another auditor in China to actually do the complete audit for the company. Right? So here you can see that there's a conflict, and that's the jurisdiction conflict that we see. So as I said, it's not just restricted to Chinese company, it happens also to European companies as well, such as Belgium. Okay, there are restrictions in terms of, in Belgium, what the auditors can give up. So that's cross-listed companies, but you can also think about multinational companies. So if I am a US company and I have operations in China, and then I use an auditor in China to audit my operations in China, then what happens in terms of the audit papers that are kept in China, right? What does that mean in terms of the ability of PCAOB that wanting to check the papers, and they're checking the papers of the parent company in the US, but having the operations in China? So there's a lot of conflict that could arise because of that, right? So we will talk more about the legal systems and the tradition next week, but have a good think about this jurisdiction conflict when you work through the workshop question, okay? All right, so that's all I've got in terms of the material. So the learning outcomes for this week is fairly short, but they're actually important, right? So one is you need to know what is meant by internationalization of capital markets. So understand what we mean by multinational companies. Think about what's cross-listing, okay? So we should be very clear what those things are. Then explain why firms might want to cross-list or operate in multiple countries. We've talked about that, the benefits that they get. And then lastly, you need to think about the governance issues that multinational corporations and cross-listed entities face. And think especially about question number 4. Is number 4? It's either number 4 or number 3 in the workshop question, right? Where I'll get you to look at that particular the article that illustrates this conflict, okay? All right, so those are the outcomes. Workshop questions are on Wattle, and next week we're going to look at governance issues in different countries, and finally I'm going to provide some information on the final exam. Okay? See you guys next week. Okay, I didn't achieve my aim, so who didn't get a chocolate? Did you not? Did you get one? You got one? No? Okay. Did you get one? No? You got one? Did you guys get one? You don't want one? You don't want? Have one. You want one? Okay, over there. There you go. It's Yanan, right? Yeah. You got one? Yes. Anna's got one. And you got one? No. You got 2? That's good. You guys want one? Or are you going to go to the gym? Do you want one? Yes. You want one? Do you want one? No. No? Very good.